My name's Ethan Braid. Today we're going to talk about dividend investing during bear markets and recessions. We're going to take a look at how dividends perform relative to stock price appreciation, the S&P 500 index, and also core inflation. We're going to look at past inflationary cycles like the 1970s and see how the dividend investor fared during that time period. We'll start this video with the long view of dividends for the S&P 500. Most people don't know this, but dividends are much more stable than stock price movements. What we're looking at here is the annual dividend for the S&P 500 all the way back to the year 1900, 123 years of annual dividends. And what we can see is that the dividend growth has been very stable. I have some future slides where we can see the dividend compared to stock price movements, and you'll be able to see the difference. It's quite significant. But here we are, 1900 to 2023, 123 years of dividends. Dividend has grown at 5% that whole time. It's really great growth. Not as much as stock price appreciation, but still 5% compound growth is nothing to sneeze at. There have only been two significant dividend events or decreases in the last 100 plus years, and that would be the early 1930s. Dividends came down 55%, had a nice recovery relatively quickly, but it took 19 years for a full recovery. And by the way, this is much better than how stock prices fared during that time. Stock market losses in the 1930s were about 90%, and it took a full 25 years for people to recover those losses if they had invested in the late 1920s. The other dividend event where dividends came down significantly, came under pressure, was 2008. 25% drop in dividends, but the recovery was pretty quick. 4 years to recover the dividend losses. Now let's take a look at how dividends hold up during an inflationary environment or a bear market / recession. Here we have the 1970s, and what we see is that stock prices went sideways for 14 years. This is 1968 to 1982. 6% dividend growth, however, during that 14-year period. The dividend was about $3 back in 1968, and by 1982, the dividend was almost $7. So no return on price. This is the purple line. This is the S&P 500 price level, but a great return during an inflationary time period for dividends on the S&P 500. Let's take a look at what this looks like for, say, a $10,000 investment. If you had invested $10,000 in the S&P 500, the price appreciation of that $10,000 investment over this 14-year period was zero. You made no money for 14 years. Dividends, however, if you were receiving in 1968 a $10,000 annual dividend, okay, now of course you'd have to invest a lot more money to receive that type of dividend, but just to keep this simple, if you were receiving $10,000 in an annual dividend in 1968, by 1982, you were receiving over $22,000. Tremendous growth in your annual cash flow. Now let's take a look at the percentage growth over that time period. Here we see the S&P 500, no return for 14 years, but the dividend had a total return of 123%. Let's compare this now to core inflation. Inflation was tough. The 70s were an inflationary environment. You can see that inflation from 1968 to 1982 was 48%. Pretty significant inflation. However, dividends beat inflation. So you can see here's your dividends increasing 123%. So dividends gave you tremendous inflation protection during a highly inflationary environment. A lot of people don't know that. It's a really important thing to think about for the times that we're in now here in 2024. Dividends are a great inflation protector. As we can see with the stock market, and this is putting all three variables on the same chart, the stock market gave you no protection during this inflationary period. Stocks went sideways. The purple line is the S&P 500, minus 0.76 for this 14-year time period. Core inflation, this light blue line, went up by 48%. So clearly inflation beat the stock market. Not good if you're an investor. But dividends were the one thing that worked for you. Take a look at a more recent example for the S&P 500 annual dividend during a long bear market and 2 recessions. We're starting now in the year 2000. The purple line is the S&P 500, and you can see very clearly no return from price appreciation for this 13-year time period. However, dividends compounded at 5% during this time period. The annual dividend on the S&P 500 around the year 2000 was about $16, and 13 years later it was over $31. Excellent growth on the dividend in a time period where growth stocks and price appreciation gave you absolutely nothing. You'll notice that the growth at 10,000 illustration for the 2000 to 2013 time period looks very similar to the 1970s. S&P 500 purple line, growth at $10,000 over the 13 years, no return on price at all. We finish at basically 10,000. But dividends, if we were receiving an annual cash flow of $10,000 a year in S&P 500 dividends, that dividend stream grows to almost $19,000 a year in annual dividend by the year 2013. Just fantastic growth over this time period and getting you through. Your dividend is increasing through not 1 but 2 recessions, which is just amazing. The percentage growth for the period 2000 to 2013, also similar to the 70s. We see no growth in percentage terms for the S&P 500, but again, great growth for the dividend, 87%. And then let's compare to inflation, and this is where it gets really interesting. Core inflation from the year 2000 to 2013 was minus 2.66. There was no inflation, which is incredible. We had inflation in the early 2000s, then deflation because of the 01-02 recession. Then we get some inflation and then deflation again because of the 2008 recession. Meanwhile, the dividend is increasing over that time period by 87%. So this is just excellent, excellent protection for you against inflation and growing your income stream over this time period. Putting it all together, we see S&P 500, purple line, 13 years, no return. Core inflation, light blue line, 13 years, no return. Dividends, 13 years, 87%. And this is really interesting. You had not 1, but 2 recessions in this 13-year time period and 13 years of no price appreciation from the S&P 500, but your annual cash flow went up significantly. It almost doubled in that 13-year time period. So think of the protection that dividends gave you from an income perspective. The annual income stream that you were receiving in the year 2000 was almost double by the year 2013. Let's go back to this chart from the 1970s and just compare dividends to stock price movements again, just quickly. Look at the volatility that we see in the purple line, the S&P 500. And again, 14 years, no return. But look at the stability that we're seeing from the S&P 500 annual dividend. Yes, it has some volatility, but not nearly as much as the price movement of the index. And over that 14-year time period, the annual dividend went up significantly while stock prices went up and down, and finished flat after 14 years. If you're a growth investor, the question you need to be asking yourself is how do you make money in a long-term bear market like we had from 2000 to 2013 or 1968 to 1982. Those were 2 long-term bear markets where growth investors didn't do so well. But if you had stocks or stock indexes, ETFs that paid you dividends, you at least had some form of return. A very critical concept to think about as we move forward in this current inflationary time period and possible bear market ahead of us. I hope this video was helpful. I hope this video got you thinking, helps you better analyze your investments, and overall improve your family's financial plan.